Multifamily for-profit, multifamily non-profit, RD for-profit, RD not-for-profit. Everybody who's represented in this room, this applies to. So let's just think about where they want us to go. Now, in fact, this conversation applies to, this initial conversation applies to all of your audits, in terms of what they want to do with risk assessment and how the peer review is going to change in the next 3-year cycle to focus on 3 things. Okay? And we'll get to that here in a minute. What's that? Oh, I'm holding it in my hand. Cycling. Cycling. You don't have to spell it anymore because you can look at the page and go, I can circle that word. Cycling. So, it taps. I'm pretty annoyed by this. Where'd the other microphone go? Oh, you're working on it.
Attach that thing.
Okay. If we look at the peer review process and the complaint, I know this is really basic. So we're going to go back to AUC 230 and say, look, what's the problem? Aside from I can hear myself sometimes and not other times. Documentation is the issue, and they're going to tell you right up there, practice aids aren't documentation. Now, what in particular are we talking about in this sense? We're talking about CX 7.1. Okay, risk assessment performed on that form, and this form has been brought up specifically in the peer review meetings. Where's a handheld? Okay, so this form is what we're talking about. It's the focus, 7.1, and we're going to bring it up here in a second and have a conversation about it. And what they're telling you here, not documented means not performed. Well, the risk assessment is summarized on CX 7.1, and that's a nice thing. Nobody complains about that. However, the work, the actual sources of audit evidence collected during the risk assessment process do not necessarily always show up on the form. There's no place for that. So they're saying evidence, the observation, the inquiry, the analytical review. So CX 7.1 is a documentation vehicle to say here's what we assessed risk at, but not how we arrived at that risk, okay? And we'll come back to the form in a second. Now, a couple of other things here about documentation. And I like to just focus on the bottom 5. How much risk is associated with this account? What's the risk of this thing being misstated? What's the risk of there being material non-compliance? Risk assessment applies to the compliance side also. How much judgment is involved? Now just think about that. How many areas in a HUD job have judgment? Well, there aren't that many, frankly. I can tell you where I see it, it's mostly in the determination of surplus cash. Should something weird be included as cash or included as a payable? It's the weirdo stuff, right? That's the judgment. Otherwise, there's not a ton of judgment involved. The next thing is, what kind of procedure did we do? Well, now that's okay. We'll leave that aside for a minute. And the next thing is the significance of the evidence to the assertion. Now, this was a key thing for me. What kind of assertion do we have, and how significant is that evidence relative to that particular assertion? And we're going to have, I'm telling you right now, the peer review is hot on this conversation, and you're going to see that from them in a minute. And then the last thing is, how much do I need to document? If it's not otherwise clear, then I have to do something to document that conclusion. That's fine. Now here's the next problem. And this comes down to a couple of things This conversation here is really a Yellow Book conversation. It's not about HUD. It's about the Yellow Book. Why? HUD RD, well, for the new future RD, they're going to tell you what to test. We don't need you. We need you to understand the regulatory agreement to determine which things are material to you. But this conversation is about your laws, regulations, contracts, and agreements that are not from HUD or RD or single audit, right? It's the same thing either way. So this is like tax credit. I have a HUD job or an RD job that has tax credit in it. We have to test compliance with the requirements in those laws, regulations, contracts, and agreements. And that's what this conversation is really asking for here. What is the summary of the other compliance requirements? Now, luckily, it's not too bad for multifamily. Yesterday, we did HUD lenders. It's just disastrous for them. So this is actually quite simple. For most people, it's tax credit. It might be your LURA. Okay, if you have a use agreement, it might be a couple of other small things. Home funds, CDBG. It's something that's not covered straight up there. And they want you to talk about which items you identified as being testable, the documentation for that, and then you get the rest of that. Okay, and then of course, the audit plan only supports the fact that the engagement was planned, not that you had the work papers to support all that. So checklist forms, look, you're saying PPC or CCH, either one you're on, we have to be very careful about how we use those. So that's a key thing, and we don't need to spend too much time looking at that. Now, if I come back to the professional standards, look, I want you to notice how this has gone. 2 years ago, and I think I even had some of this last year, failure to document planning procedures. Think about this. Your analytics, your IT consideration, internal control, and then of course the first one, which I skipped on purpose, the risk assessment. And then they want you to have that word in here about linkage. You know, I remember old movies about the Scopes monkey trial, Spencer Tracy, something about the wind. I can't remember what it's called. And they're all worried about the missing link. Still talking about the missing link. I don't care where that is. The missing link to worry about is in audit. The missing link is this. And by the way, the form, we're going to go to the form. And it's going to tell you on that last column, comments or linkage. Like there's some magic button to spin or push that's going to say, here's the linkage. Whoop. And people are going, what do I need to write for this? And I'm going, we'll come back to that. The linkage is a bit of a mystery, and you're going to get pounded over the next 3 years about this. I'm just straight up telling you, this peer review cycle, it's on the books. They're coming at you for this thing. I don't really have a lot of problems with the fraud consideration. Heck, the whole audit's to detect equity skimming. Equity skimming equals fraud, so let's not get too excited about the fraud conversation for multifamily. I think we're doing a good job. Documentation, that's fine. I don't think that's a problem. Sampling, accounts receivable, we don't really need to talk about that either. It's just that peer reviewers come out. Where's this really showing up, that comment? That comment's coming when you go to a RAB or your peer reviewer gets reviewed in Charlotte. Maybe somebody from the AICPA is looking at it and they're going, why didn't you confirm receivables? And the auditor's going, well, because it's a multifamily project. We're trying to keep them from urinating off the balcony of the apartment. Not trying to figure out whether they're going to, or coming in to get recertified, and we're worried about tracking their income in EIV. We're not certainly going to get them to confirm receivables, which are immaterial. And they're asking that question. Why didn't you do it? Well, everyone in the biz knows I'm never going to do it, but they get comments on that. So we just need to say why we didn't confirm that. But sampling is another thing we're going to have a conversation about. I just got off a guy who the peer reviewer failed him for some audit, 94 nonprofit audits. He didn't like how we sampled them. And he said the F-bomb to the guy. Worst Thanksgiving in history for that man, by the way. So we're going to address what that challenge really is for it doesn't really matter. Now, from the peer review perspective in the slides, here's what you're being told. Risk assessment at the account level and not at the assertion level. That's what the reviewers see. We're also seeing that you do not assess the difference between risk assessment at the account level and the financial statement level. Focus is on that form. Now, they're going to say something on this form, and we're going to go to this particular document from the AICPA. And I apparently didn't get it open here as I was getting ready. I clicked on it, but I guess it didn't click good enough. This is in the list of materials. If you go to our website, and Kathy sent you the link. Come on, click. There we go. Hell, I'm mackerel. I don't know what's going on up here. At least the microphone's working. This document has been sent by peer reviewers out for people who have had peer review in the last quarter of this year. So what they're going to tell you straight up here is that the members of the Auditing Standards Board state that if an auditor is not doing a good job with AUC 315 or AUC 330, AUC 315, risk assessment standards. AUC 330, further audit procedures. Okay? Just put that in your mind. If you don't follow those standards, it's going to be really hard for you to actually test the right or get the right audit evidence to support your opinion. Therefore, the peer reviewer will have to determine that you are a non-conforming engagement. Now, that's a pretty straight up statement, right? Therefore, it will be difficult to conclude that you are conforming. Examples of, well, things that lead to failure, okay? Identifying risks. They said virtually every audit, no matter how small, has at least one significant financial statement risk. Okay, keep that in your mind. I agree with them in this case for housing. I know exactly what that risk is going to be. That's easy. Then they said, just what my slide showed, we see confusion among audits where the audit firm assessed risk at the account level and not at the assertion level, or they confused account level risk with financial statement risk. It just cut out again. I could hear it went dead for a second. So, failure, if you think about those two things. Now, why are we having that dilemma? That's an easy answer for me, and you can see it immediately. If you open up CX71, and the focus at this meeting, this form was brought up on the screen with all the peer reviewer folks there, and with PPC in the room, and they spent the afternoon trying to defend the form, and saying, well, if everybody fills it all out, it'll work perfectly. And that's nice, except probably nobody will ever fill it all out. And you all know that's true. And I know it's true. But here's the first problem. Risk assessment documentation approach. By audit area or by assertion. Well, heck, that sounds like I can do it one way or the other. Nope, that isn't technically true. AUC 315 says this straight out of the standards. The auditor should perform risk assessment at the assertion level and the financial statements. So this is a little misnomer. When you read back into the details, it said if the account is really, really insignificant and not that important to your audit, we'll let you assess it at the account level. But people are reading and going, oh, let's just set it at high or low or whatever. That isn't technically true. So just disabuse yourself of the theory that you can go at the account level and say cash is low risk. No, cash is an assertion level thing. Debt is an assertion level thing. Property, plant, and equipment, assertion level assessments. So that's the first step in that conversation. Yes, sir. Go ahead, John. Yep.
Let's say you mark out that, just a mechanical thing. Say you mark out that by audit area or, that goes away. And you've got like, 6 assertions there. You mean you have to go down the line and assess, as just if you're filling out their form. You had to go down for one assertion, then the other assertion, then the other assertion, and decide whether it's high, low, medium, or whatever. Is that the answer?
In theory, yes, but it's not quite the answer, okay? And we'll show you why, okay? When you get to multifamily, there's some things we can assume about. These things are all pretty much going to be very close to the same, right? But that is the theory. So you would strike out the by audit area or, I just say, it's by assertion, and then the only option would be if it's really low, I mean not in terms of risk, but importance, you might on a few accounts just assess it at the account level because it doesn't matter. But that would be very few, right? It's the exception rather than the rule. Now, we're going to walk through these individually for housing today, so we don't have to get too excited, but just yet. Let's go back up to the financial statement thing. Look, if I'm filling out this form, the number one risk in a multifamily audit is equity skimming. That is a financial statement risk because it can happen from skimmed revenue, it can happen from expenses, it can happen from management fees, it can happen from, I don't know, 3 or 4 other places, right? So multiple accounts, multiple assertions. That is the classic definition of a financial statement level risk. For me, that's numero uno in this audit, equity skimming. Now, even if it's a nonprofit and has residual receipts, the risk stays about the same. It's just how we're going to achieve that might be different because it's going to come back to avoiding residual receipts or some other thing, but it stays about the same. Now, most people, having gone around the country now talking to a lot of the larger firms, the classic thing they'll put in here is management override controls. So I left it here, but let's be honest, what's management going to override controls for? Probably equity skimming. Yeah. And RevRec, I don't know, for me, I don't think it's possible to really get a ton of revenue recognition risk out of here with a project with stated GPR limits. So RevRec, to me, revenue testing due to overstatement of revenue due to fraud. Or you could get to the new RevRec goals for the standard, but quite frankly, they're not going to affect us in multifamily. But that's about my list here, okay? At its most extreme, those 3. So we would come back to that then and realize those are the risks for multifamily. I mean, you can just put it in the bank. Rodney, RD's the same list, isn't it? Worrying about taking too much money out of the project. That's why you're going to cash disbursements, test repairs and maintenance, and miscellaneous admin, right? That's where the leakage, they think the leakage is biggest. So that conversation stays very consistent for us. Now, swapping back to their list. Failure to document or perform or document the performance of procedures that address anything beyond basic. Now here's where we're getting to the linkage conversation. Okay? When the basic procedures don't address risk, significant risk requires specific consideration. Well, everyone in the room goes, duh, right? So why are we having a problem with this? I don't know. It's the form. It's kind of that form problem. So here's the next statement. Reviewers should consider the linkage between the risk assessment and the procedures and determine whether the procedures are responsive to the client's financial statement and assertion level risks. Now, the first day this came, when it was given to me, I was on the road, and I can't remember where I was at. Like, it might have been actually in Minneapolis. And somebody in the room that day were 4 peer reviewers. And to a person, they basically said, here's the concern for us. We're more worried that we're going to get hammered for not identifying your over-auditing as much as we're going to get beat up on looking for under-auditing. Now, what does that mean specifically? So here was her example. They'll check your form on CX71. They find the inherent risk of debt, mortgage, set to low. But what's the one procedure everybody knows you're going to do? No matter how much I tell you, don't do it. You're all going to confirm the mortgage. Okay? Just know it's going to happen. I'm done swimming upstream. I'm not that nice of a salmon. So they're going to do it. And the peer reviewer said, look, if that's the case, confirmation is what is typically thought of in the standard, has a documentation required for a higher risk area. Why did you confirm the debt if you set risk at low? Well, I just wanted to. Yeah, I felt like it made me feel better, right? And so the next response out of somebody's mouth, probably from the back somewhere, yeah, that's what I would say. You probably heard my speech already, but they're going to go, ain't nobody going to tell me what to do. I'm done. What I want to do. Nobody can tell me what to do. I get it. Trust me, nobody gets it more than me. And the peer reviewer said, I get what you mean. However, right, here's what's going to happen. When it goes up to Charlotte, the secret is with Charlotte. We got a trivia game coming up tomorrow on movie quotes, so I was getting ahead of the game. They're going to say, why did you confirm that? Well, I didn't think it was that risky, but I wanted to. And I'm going to tell you the basic answer is I'm going to set my escrow risk higher, and I confirmed it for the escrows, just like you said, sir. So I didn't confirm it for the debt. But if you say, well, I just wanted to, they're going to say, well, then what you're really telling me is you didn't assess risk appropriately because you felt really internally that risk was higher, so you wanted to confirm. Now, this is a kind of a zero-sum game to win, right? We're just sitting here chasing our tails around to get this done, but you can see what's going to happen. Now, typically, we're paranoid about under-auditing. This crowd completely over-audits, has a general comment. I just know that's how it works. And I don't feel bad about it necessarily, except if this starts actually being a real issue. But what the issue really is risk assessment in general, okay, on the form. Now, the last comment on here is just simply the idea of failure to evaluate the design and implementation of internal control. Consider what could go wrong, right? What could go wrong, identify controls, evaluate the likelihood of those controls. This is on every audit, not even adding to the fact that it's compliance. But what do I go out and see 90-something% of the time in work papers under control risk? It's always sitting there with a big, fat, juicy H. And I ask everybody why. What's your answer? You could all say it together. Because I ain't going to test no controls. I'm not going to rely. Oh, that's such a falsehood. And you can't do that. I'm just going to show you why that is not a good thing. This is the one area where they really have a point in my book. This is a point. The rest of this is a form over substance conversation to get some things done. So you're looking at the form. You got a couple of things here. Assess it at assertion level. And you're being told this control thing is a little problematic. So we're good at that. And so we'll go back here and just summarize what did they tell you they were going to do if these things are in place. You can get this letter everywhere. Many peer reviewers sent it right out to their clients that they were peer reviewing this year. So, fail to comply with risk assessment. And it's an isolated incident, you're going to get an MFC. Okay. This isn't the end of the day necessarily for you, but let's go to the next one. Failure to comply and it's systemic. Oh, we've moved up to an FFC. So all your jobs had a problem with risk assessment. But if you have a problem that's systemic and it results in deficiencies or some other audit procedure, what's that? Oh, it's in the hallway. They're confused. They want to know what time the drinks need to roll away. And you're really thinking, are they talking about bringing the drinks out for the thing out here after this pain is over, right? It's alcohol cane. Just drink it. You don't inject Novocaine. You're just going to do that. So you want to talk to all your friends and see if they're not going so you can drink too. So you're going to get a significant deficiency, or at least a deficiency, or maybe a significant deficiency, and some of the feedback coming back is that's going to be one or two of those, and you're going to have a real problem. Is that right, Dan? That's what he's hearing. Dan got to hear a little bit of this yesterday. He's so happy to hear it again. And they've changed the questions and so on down the list. Okay, now having said all that, what we're looking at, okay? Management override controls, further audit procedures should be appropriate for the response to the risk. Now linkage, on the form, right, it says linkage. And they're expecting you to write some magical thing in there. I don't know what that might be. But what they're really trying to say is, I want you to tell me or show me how the procedure selected is a direct response and an appropriate response to the assessed risk. Now, if that's a marvelous little piece of text, I don't know. Okay? But in many ways, I think it should be obvious to what you picked. And they're just saying, if that risk is low, but I've picked an extended procedure, I broke my linkage, right? So that's how that's kind of going. I don't know that they expect anything on the form to be written there. And then internal control. And what does the HUD and RD both require now? Single audit? Testing of internal control over compliance. Mandatory step. Now, the ladies talked a little bit about single audit this morning, and I just wanted to bring out the couple of conversations. I had this class in somewhere in Baltimore this year, and the quality partner, the managing partner's in the room, the quality partner's in the room. I got a bunch of staff people, and she told me the week before they had one of the really well-known AICPA guys was doing single audit training. Bill. What's his last name? Come on. Yeah, you all know him. Many of you would know him. And he was there 2 weeks earlier. Then the next week they did planning on single audits. The next week is my class. You know what the partner told me, the quality partner? Out of the 10 engagements she reviewed, less than 1 week later they did the AB risk assessment wrong. Less than 1 week. A little dismayed. Now for multifamily, that's really simple, because you just don't care. You already know the programs. AB, SHMEB, I don't care. Look, I'm going to pick the mortgage. Yoo-hoo. And we sometimes miss that form stuff because we're not that interested. We know what we're going to pick. Public housing, we have more problems for sure. But multifamily, I don't see the biggest problem here other than it's just simply a matter of filling out the form, because we're picking the right programs. The testing is correct, but you get beat up for it anyway because you didn't fill out the form. Form over substance every time. Okay, now that was fine. Clustering, I don't really have a lot of problems to talk about that kind of stuff. But testing of internal control, and this applied to everybody, so I left the slide there whether it was single audit or not. And then, of course, for single audit, failure to get to low. Think about that, right? I have to plan to get to low on a HUD project. That means cash should say low in 7.1. Because I can't separate the compliance testing for cash versus the financial statement testing for cash, because guess what? It's about all the cash. There's no one little piece of cash that HUD doesn't care about, unless you called it entity cash. And we don't see that much of that. So this problem is fairly significant for us in general. And then the plan sample over controls over compliance, we'll come back to that. and just failure to document the testing of controls and compliance for the relevant assertions. Oh, where would we start with that form? Now, for most people, I'm going to put that off I'll do it here. Okay, now let's just go through the AUCs a little quick. I want to do this very quickly and get through this. So, paragraph 14 of AUC 315. I need to get an understanding of controls, evaluate the design, and determine whether they have been implemented by performing procedures beyond inquiry. This isn't about testing and reliance. This is about evaluating. And then the Q&A comes back up for the peer review, says, do I have to get that understanding on every audit for every year? Yes. Yes, you do. I get flexibility, though, in what I do. I can rotate controls. Maybe I have a 5-year schedule, right? We're going to rotate through this understanding. And it's, something we're going to have to do. Get an understanding of the information system related to processes. Now, this form is pretty good in PPC. You're documenting processes, okay. What form is that? It's like 4.2? I can't remember right now. So that form's pretty good. People are, in fact, what most people are doing is documenting processes and not documenting controls with assertion level accuracy. Okay, so IT, that's fine. Understanding the information system. I don't have too much stress over this. People are pretty much in the right place where they need to be here. Okay, so I'm going to skip past that. Do I have to get this every year? Yes, you do. But make sure we identify the differences between the processes and the controls. Okay, one more slide here, 2 slides. What's the next thing? Identifying the control activities relevant to the audit. Okay? And look, you're not going to get a big conversation from me about doing that, because there are some things we're going to do here very quickly to get out from under a good share of these dark clouds. This does not have to be a painful process for us. And trust me, the way I'm thinking about it, we're not talking about that much additional time. The things you're going to look for, frankly, they're pretty easy to see. It doesn't require an understanding of all activities. It just says I should get, at the very least, I should get an understanding of the process of reconciling records to the GL for the material account balances. That's a minimum. Okay, so what do I get plenty of judgment. The ladies talked about that this morning. Carol and Tony both said you get a lot of leeway in how you do this, but controls over journal entries are specific. Now, before I move on here, let's talk about the form and just talk about how we're going to move out of this area to find something a little more palatable. Okay? Now, you have the forms in general, and I'm going to just open up another form here. This one is one of my favorites. This is an all-time favorite form. That is not it. I have no idea. I'm not even looking at that form when I clicked on this, so that's fun. And then it clicked off my screen. Okay, how many of you love this particular form? Drum roll. Takes for, I don't know what is going on here. CX 5758 59 510. Boy, I'll tell you, I'm going to tell you, you should fill out this form and you're going to chase me down the hall with pitchforks. Right? This form is a great form, except that nobody can use it. Now, I have met 2 or 3 groups this year who said they filled out this form. So there's always people who do it. But if I'm looking at this form, processing cash receipts, delinquent AR, boy, here's cash, right? These are controls over cash. Man, that is the slowest scrolling mouse I have ever seen right now. Cash controls, right? Then you're going to fill out 8, 9, 10, 11, 12. I think we're near the end. Okay? How many of you want to fill this out? Just raise your hands. I'm not going to give you gift cards for that. This is a terrible thing to go through, isn't it? I'd rather have a root canal. At least I get, well, Kathy and I always get it. We always get gas. We're always looking for a little stress relief. Even if I have to pay $800 for that procedure, I'm sucking the gas. That's just because, neither of us are going to drink Jack. If we just take a cheap way, we'd get past this form. Okay, so look, what we've decided to do is this isn't going to work for anybody. And how do we make sure you get out of here as quickly as possible in the least amount of pain with the most amount of gain? And so look, I had this last year. I'm showing it again for my tools, internal control. We've made a couple of changes this year to this form in Excel. This is on the website right now. It's in the class materials, I believe. And this is really CX41 and CX5 et al., 7, 8, 9, 10, 11, 12, in one spreadsheet, well, in one workbook with a couple of spreadsheets on here. And I have no idea what I've done to this computer to just cause it to behave anciently. This entire day has been ancient day on technology. Okay, first of all, if we were going to replace CX41, and I do like to replace it, unless it's on this computer today. Look, the goal for all this was to make an evaluation. So it said evaluate the client's control environment, evaluate the client's risk assessment process, evaluate this, evaluate that. How do we make evaluations? Now, invariably I'll ask some young lady, look, someday you may meet some guy down here in the casino tonight. Whatever. You're going to evaluate whether this is a good guy or a bad guy. Now, how's she going to make that evaluation? Well, a lot of it's intuitive, right? This guy creeps me out. He's in accounting too much, right? He wants to talk about internal control. But in the end, we're always comparing to something that my wife says, I have a mental list I compare to. Oh, I want to buy a car. This is an interesting thing. I remember the class I took in college, political science. It's the highest grade I ever got. It's not even close, like 110%. I should have been, never mind. And I realized how the world was twisted, so I said no. I went to accounting instead, and now I'm talking about risk assessment. One unique thing I remember about that class, they said, look, certain things are decided by emotional something by the time you're age 5. One of those things is how you're going to vote. You're going to self-identify as Republican or Democrat, right, or something like this, which was probably true. You're going to probably have a favorite sports team, and you're going to decide on the brand of vehicle you really like. Studies have shown that. They're going to be emotional choices you make. Well, we don't make good evaluations when we're looking at our emotions. How do you feel today, Les? Or, hey, Les, what's the right internal control for me to have? Well, the ones at work, right? I mean, segregation of duties, got to have that. So they ask us questions. We're not really great at this. So we started looking at how we do evaluations. Well, I can't compare you to something because I don't really have an idea what to compare to. And then usually one of our speakers here, Marlo, he said, Les, we don't really have to do that. You know what we all have to do? All we have to do is compare it with a list. What does my client do on the list? Is that enough? I said, well, hell, where's the list, Marlo? He goes, come on, Les, it's in PPC. Nobody ever sees that list because they fill out CX41. So what we did is we took that other form that nobody uses and put it down in a spreadsheet and say, look, ask the client to tell you which of these things they do. And I get people telling me, my client's never going to take time to fill this out. I went to New York City, met with these guys running 40 projects, hardcore New Yorkers, right? Hell, they were arguing among themselves at the end of this conversation. It took 45 minutes. I had to shut it down. Oh, we do this, we do that, we do this. Look, if you back it out, the key was to get a picture. I like pictures. I can't really understand too much language, so you look and see how the controls, ooh, that got tiny, mighty fast. See, that's all it's in a matrix, you can see all that. The client just marks down which of these things they do. They fill out it in a little checkbox. Now we come back to the list, and we just hit refresh table. Now we know the things the client said they do. One per management company. They don't change a lot year to year. If I want to do something else about like testing, because there's maybe a couple of ideas on why I would want to do that, I just pick yes, they change color. Now this is CX41 replacement. So I haven't really gotten too deep into this. This is just a better evaluation than other things. I step back, drill out a little bit, move it out, look at it, is it enough? That's a good evaluation. Now the control activities represent a little more of a problem. So what we did was took the CX forms, and the controls are over and over. If you look at some of those, they're on every form. In fact, 60% are on every form. Well, then it got to be like a joke filling all this out. Like, why am I doing it? Well, you put it into the matrix and just said, tell the client to fill them out, checkbox, 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 one per management company. It could cover 40 or 50 audits. Now what happens when you come back to the list? You hit refresh table. Now what did I get? I get a list from the client, right? They've said this. I can look down this list and look for gaps. So I got a 2-column gap here. I'd be looking at what that is. So I can't read that right now, it's too small. But I actually have a process now. What did it tell me? Account number. Oh my gosh, just somebody shoot me with slowness here today. I get it by account number, or account type, account, process, and they gave it to me by assertion. Gosh, that was faster than I thought. Now, I wanted a test. The first one's a great one. Management reviews the financial statements. What would I do if I was an RD? Not only management, but RD sets the budget and does it monthly. Well, why would we not be testing that control as it covers virtually every one of these things across the top? Now, that's a proper assessment. We can go out and pick a few to walk through over a period of 3 or 4 or 5 years. You start walking through a majority of these, get an understanding. Most of the testing is not that hard. And guess what? Here's the real kicker to this. Does HUD concern itself with the project cash, or RD? Well, that's an easy answer, yes. Does HUD concern itself with the prepaids, the intangibles, or other assets? Yes. Receivables and revenues? Yes. Property? Yes. Look, compliance is everything. There's not a dollar of cash that comes in and out of this project that doesn't pertain to compliance. There are no expenses that evade compliance calculation unless they're in what? Entity, and then they're measured against surplus cash anyway. There is no ability to segregate out compliance from the financial statements in a multifamily job. Both entities, HUD and RD, control everything. It is all compliance. I would ask Peter will bring that up in the morning. So we're going to show that. So look, I've tried to give you a tool to make this go away. Pick it'll generate an audit program for you. You get it by assertion, by account, by process, and I think you can slay most of your dragons. What? I probably could fill that out with the client in about, I don't know, 30 to 40 minutes. And every client I've done it with personally, oh, by the way, nonprofits, what do you want out of this? Your client wants a copy of this because when they walk away, they can show how they complied with the best practice of COSO. They need this. This is exactly what they need. They couldn't do this to save their skins any other way. In fact, neither can we. We just can't do it. If I'm waiting to fill out those forms, hell, I'm going to lose hair and let it go gray at the same time. So anyway, I think as far as I can see, if anybody has suggestions to make this work faster, boy, we will implement them as fast as we can find out if we agree with you. At least when little buddy comes home from France, because my Excel guy's in France right now.
Are you saying fill this thing out instead of that previous COSO thing that you?
This is the replacement of it.
Okay.
What we've done is we combined the COSO and the control activities into one list and said, look, we can get internal control. So what's the key point about internal control? Summarizing my real problems here. First of all, you cannot segregate. You must test internal control over compliance. And that generally means you must test internal control over the financial statements. Because I can't separate any of those areas. John, have you seen HUD ignore any significant parts of those projects and say it doesn't matter to us? Not only no, but what were we smoking? No, right? Yeah. It's heck yes. So if peer review says I'm not getting a good evaluation, it must be because we don't fill out the right forms. And that's easy to see why. The form's too painful. This way, I actually get the client to assist me. We write it down. They get it summarized. The worst thing they have to do is go back and accumulate a few documents to support their assertion they have it. They have a policy, a code of conduct. They have, so they have those documents. They have a tenant selection plan they follow. They have all these things. So the only control I didn't put on here right now that I will add for tenant files. Here's the controls you need to think about, frankly. Remember this one thing, two things. HUD recalculates everything. RD didn't want to test the files, did they, Benny? Because they recalculate subsidy. HUD does too. They don't do anything until they don't pay until they recalculate. The second control is, almost every management company does it, somebody's QCing the files. Gosh, that's about it for tenant files right there. So, compliance. I would add the other thing that they review their documents. We'll talk about individual risk assessment later. Okay, so from an internal control perspective, I think we can help you do that. Yes, sir, Jeff?
Where's that located at? What's that thing?
Yeah, that sounds good.
Kathy, isn't it in the list? They're asking where that is. It's in the document list for the program, right? There's a link for the documents.
I'm on the website.
I can't hear you. Kathy doesn't want us talking to the microphone. In fact, she's annoyed.
You're going to have to refresh the page. It's the last link.
For the, if you're in the class documents, well, here, let me just bring it up. I don't actually have the link on my computer. This is something I should never do. I can't find it on my own website. Kathy can do it all day long.
You have to log in, so you don't want to do that. I'll just email everybody the direct link. It will be faster.
After the break, we'll just show the link. Look, we know how things work in our office, right? I mean, there's no questions. Everybody knows. You're going to agree with me that, yeah. Okay, so it's there. I'll make sure you get it either today or in the morning, okay? I'll show that link. Okay, It's a freebie. Yes, ma'am.
So in your, that spreadsheet that you have left, you still have that program tab to lay out exactly those procedures and based on the key controls that were identified.
Go
Is
ahead,
that still
repeat
there? So I was just wondering, and there was a program tab for your controls. So when you identify the key control, then the program tab would document what procedures.
I'm going to test. If I pick
Right.
the test button, it generates a program step.
Yep, and that tab is still in that workbook.
Yes, ma'am.
So that documentation is all done.
All in one place.
Yep.
And so what we got, assertion, account, it's all there, pick a program. The linkage is pretty shown. I mean, you can't miss it. I didn't make it up. Somebody else made it up. PPC copied it. I copied them. So it's free. He probably paid for PPC form, so I just redid the form for you. Okay? One of these days, I'm going to take it outside of housing and just sell it for all auditors and just make it sexier. But right now, it kills everything as far as I can see. I can't get much closer to it without a significant increase in pain. And I think that's as much pain as I can go, gain for pain. Okay, now, so we got to come back to the overall idea here of risk assessment now. Let's go, we'll jump past controls, go to risk assessment. Then they said, look, so here's 315, paragraph 26. This is straight out copied from the standard. Quite frankly, I don't really spend too much time on forms. What I probably do is read the standard and say, what do I want to do to make that standard, make sure I've shown that I meet the standard. A transaction level, account balances, and disclosures. So the financial statement level, which in our case would be primarily equity skimming, the relevant assertion level for transactions, balances, and disclosures. Now, 27, paragraph 27 out of there on the third bullet. Identify the risk throughout the understanding of the entity and its environment, which is fine, and we know, most of you know that really well. And then the third one, relate the risk to what can go wrong. Now, one of the things John mentioned here about assertions, look, the truth is if I'm on cash, half those assertions aren't that important to me. Are we going to have a classification problem with cash, John? Or value? How about valuation? Should we assess the assertion for valuation? Some of these really aren't that relevant. So we're only being forced or asked to assess the things that have real risk associated with them, based on the what could go wrong. And then the auditor says, are any of these significant in my judgment? So we get the judgment call. We love our J. And this excludes the risks with controls. Now, exercising judgment, look at this. There are 6 questions about how much risk, goes on. Is there a significant risk of fraud? Is there a recent change economically or accounting developments? This year, that's clearly true in the nonprofit section. Equity, well, if it wasn't so easy, I would say it was an increased risk, but, it's mostly a disclosure challenge, right? The risk there is disclosure. How complex is it? Well, we don't have anything too complex in multifamily. I'm happy about that. It's simple. Related parties. Oh, now we hit something that's a little more interesting. HUD and RD both worry significantly over related party transactions. So, okay, that one is a concern. Mostly where? Cash disbursements. Okay? How much subjectivity is there? Or there isn't much. And how many weird things are there that didn't come out of the normal course of business? Well, there aren't too many of those either generally. So then they said, look, questions. Now this is important. In large or significant accounts, inherent risk is rarely low. Now whether or not we agree with it, just run with their theory. So go to the question. Where risk of material misstatement for any relevant assertion or significant account is indicative of an inherent risk assessment set at less than high. Is there a reasonable basis to conclude? That is the question, okay? So we're being forced to ask that question. Is there a reasonable basis for us to conclude there? Okay, that's easy. Okay, the control risks, I think we've covered that enough. And I think the question, is it set at less than high? Has evidence been obtained to support the level of reliance? Is the auditor relying on service auditor controls? Whatever. I think we've settled that. And so, we need to deal with risk assessment. Now, I have a little spreadsheet that's not quite ready for prime time. Based on these latest things that have come out, I need to tweak a few things, but I wanted to just use this as a basis for discussion. Oh, I think I know what's wrong with this, Kathy. Why it's so slow. And it's something I can't rectify right now. Okay. Now, I'm a visual, like I said, everybody knows, I've already said it a dozen times, I'm a pretty visual guy. And I like to see all my stuff in one place. All my shirts, my white shirts, my blue shirts, my colored shirts, all hang a certain way in the closet, blah, 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 blah. So yes, I am a weirdo. And I cannot make this computer run faster. Okay. Now, let's look at cash. I know you can't see this at the back, and I couldn't figure out a way to print this to make everybody's life easier and hand out a piece of paper. So I'll just keep enlarging it till it fits some window process here. Okay. Here's cash. This is easy, right? Now, I started this process by really on another tab. And by the way, there are many ways to do this. The big firms all have their own way. Resnick has a big database. They're running in one spreadsheet. My goal is to have it all in one workbook with other than attachments. So everybody has their own way. And there might be many ways to slay the dragon. Okay? But in this particular case, this is how I envision it working for me. I started off with an idea of what could go wrong with cash. And in most cases, it depends on the project itself. So this project, the one it's looking at now, this actually went through peer review like this. This project has a HAP contract and a conventional mortgage, and the HAP contract does not restrict distributions. Okay, we can start with that assumption. So when I looked at this, let's just go through a couple of questions. I have in the planning column there $73,000. But the other thing you need to know is the guy's owned this project the last 18 months. The first year he bought it, in 16 he bought it, went through some rehab, smaller rehab, but all energy efficiency stuff. So I'm comparing cash to cash. Now I asked myself the question, what's the likelihood that that cash of $73,969 is not in existence? What do I have in my hands for risk assessment procedures? I have a bank statement, I have the general ledger, and I have a bank reconciliation. All three of those documents are in my possession, and I've probably made sure that the bank rec ties, blah, blah, blah. And I made sure there's not any weird outstanding checks or, deposits in transit. So what's the likelihood that the cash listed on the GL is not in existence? What do you think it is? Sorry, you're on the front row. And you have a nice look, pleasant look towards me, so you're not hating me yet.
No.
Probably now you do.
No.
Is risk high or low there?
Look.
Low. It's not only low, it's like how much lower could it go, right? I'm down near negative. If I could go to negative, I would be negative. Now, what I know by that is it's in existence. And the evidence for that was the bank rec, the bank statement, all the testing I did to foot and cross foot the rec, and tie it all together. That is done. What is the next problem? Completeness. What is the likelihood that the cash that's supposed to be in the project is all in the project? Now, what is that assertion? That's completeness, and that is a specific HUD or RD concept that they say what? All the cash must make it to the project. The compliance test of cash receipts makes it mandatory is because they say all the cash must make it to the project. The owner didn't skim any off to the side. Oh, so actual compliance testing is just basically a completeness assertion. That's all it is. So people tell me I have to test compliance for cash receipts. Well, I'm really only asking you to make sure the cash is complete. That's all we're doing. So, what kind of procedures would I do? Now, if I have to set risk, what am I going to do? Now, these are just concepts. If the ladies from Plant Moran today, or Resnick, or others, I can't tell you how many I don't see, but the ones I do see, much more into a lot of analytical review procedures. I did some of this last year. This stuff came off the GL, a couple of quick, easy sorts for debits to cash. So they told me there were $1,113,713 debits to cash. Now, I took the credits to revenue, and I had an estimate that came off my planning from the gross potential rent. Every other number came off the trial balance, and we're trying to reconcile down here to this. So I took out the other deposits, which won't come out of my gross potential rent, and the security deposit money came from another source. That's $1,080,000 in debits to cash. Revenue reconciled out to about $1,083,000. That's not really compliance. It's just my test, right? My expectation test. Gross potential rent was this. Some adjustments to get the differences out. And I'm showing that I have about $3,399 to $3,400 difference between cash I had, revenue I booked, and what I expected. Is my completeness assertion high, moderate, or low? I think it's low again. And in fact, it's really low. Now, what I've done by this analytical review, I have proven the completeness assertion. And what I've really done is showed that the compliance test of cash receipts is basically been handled. This was done at year end anyway. And the remaining detection risk is low enough, based on the sampling guidance in the ANA guide, I do not even need to sample it. That's a really 100% analytical review test, and it's going to tell you a ton more than a bunch of samples. People are going in this direction very quickly.
Okay, what are you going to do about the HUD compliance test
That says I should have to sample?
they force you to do, basically?
Okay, here's what happens. The peer reviewer walks in. This is Quas. So Quas walked in this year. What did they see? They saw a different cash receipts test than the suggested sample. Were they happy with it? Yes, they were. They walked right on by and said, "You've tested cash receipts." Amen. So I went through a peer review and I went through a Quas review, and this theory what were they most upset about? Areas where we ignored it.
Say this doesn't work, so then you should go to further.
If this, now, what we've done, only thing we've done, John, is set risk assessment. We've done a bunch of procedures. It took me about 20-something minutes to do this, okay, if it's set up correctly. I have to do further audit procedures now, too. I can't stop here. I have to do further audit procedures. Those procedures may be I go back and look at vacancies, I go back and look at AR, maybe I do this at interim, I update the analytical review at year end. I have to do something else. And there may be another reason to sample. I haven't really decided. All I know at this point is completeness assertion is low. That's all I know at this stage. I know it really well. Well, okay, this guy went a little crazy too. He actually took that information and built his own cash proof off to the side, right here. Now on the expenses, we did it a little differently because number one, the second thing I have a big problem with is rights and obligations. Are these expenses my projects? Are these reasonable and necessary expenses of the project? That is simply just a rights and obligations assertion. Do these belong to my project? So that's exciting. Now, and that's off to the left here. This is the expenses. And from that, these came off the trial balance, and we had the disbursements off the GL or the cash from the GL. And he basically forced this out. He knows where all the cash went. He did this from QuickBooks, and I have his little routine. He probably took about 15 minutes to get all the data organized. Once he put it into his routine, the only problem was just transferring it over here. And the peer reviewer saw this and said, man, woohoo, you know everything about cash. Now, what's the one thing we knew? We still have to cash disbursements test. There's no escape. And we knew that. But we assessed the risk of all this. And so what we said to ourselves, here's what we learned immediately. Most of the compliance stuff relates exactly to assertions for every account generally, except what? There's one compliance thing that I'm related to assertions in reserve for replacement. See, it does cut out there somehow. And then the other one is in tenant file testing, right? That's all compliance generally. But those areas, almost all your financial auditing is tied to one financial or assertion or another. Okay, now that's easy for cash and it's a little extensive, but it gets much easier as we go through this. However, we'll talk about it after the break, but right now I'm going to play Kahoot. Risk assessment on Kahoot. Oh, we didn't open it, Kathy. Oh. Please, internet work fast, internet work fast, internet work fast, internet work fast. I'll wrap up I'll go through a little more of this in the next session, because the next session is a little potpourri-ish. I'm a little nervous about it, frankly. What's that? Yeah, we'll see. Oh, I'm just so frustrated right now. I haven't got to the end yet. I'm supposed to give you before you go? I'm going to remind you while we're waiting, it's cycling, because if you run out of here fast after the game. The code word was cycling. Oh. Well, I'm supposed to go till 3:40, and the game will take about that long. Why don't you take the break now? We're going to end a little early anyway. Let's take the break now, and we'll be back in 10 minutes. So you got your last word, cycling. Get out of here while I'm waiting. You go have a refreshment while we're goofing with this. Okay, let's start going. Think I figured out what was wrong with my computer, so now I'm feeling happier. No, we were trying to get a copy of the presentation on Zoom, our video presentation. We were trying to do a screen capture, and in the last 2 times I've used it, we use it online for our online training, and both days I had problems with documents opening and the speed of the whole thing, and it was only right now I realized that they're 2 different computers. The only thing common to me was the screen capture software we were using, so I just shut it off. I can't handle the frustration. What we'll do now is we'll just link another computer to that computer, share the screen back there, and capture it back there, but here's up to speed. We're almost all here. Half of us are here. Half of us are here. Okay. Look, this is what they called audit quality. It's sort of risk assessment. Can't win. I don't know. I can't win either. Don't play. Just be the moderator. Then I never get tested. Beer 30. Beer 40. It is beer 35 right now. Okay, I'm going to start. We into matrix. Take the red pill, not the blue pill. In fact, I'm going to stay in the matrix. I want the blue pill. I want to stay in the matrix right now. Abstracts, copies of all significant agreements. Primarily helps the auditor too. Remember, this is a yellow book question, not a HUD major program question. The music kind of gets to your weirdness, doesn't it?
Yeah, it's pretty cool.
Determining the testing requirements for laws, regulations, contracts, and agreements for financial statement purposes. It's not about internal control. Oh, by the way, some of you are probably itching to leave your seat. Don't play your flute on the way out. Flute. Cool hand flute. Okay, how did that turn out? Lou reached up there fast. 847 points. Oh, 41. Sorry, I'm off to the too far. Different spectacles. Okay, here we go. AUC 230 documentation standards do not include which requirement? One of these is not a specific thing to document. Client judgments. We love that spread. Yes. Now, 36 of us here. We don't have to document who did the procedure. Just think about that again. I think you were just misreading that. Beer 30. Hammond at the casino. At the Cosmo, I mean. Okay, look, it's close. 55 points from the top 5. I have no idea what the next 10 look like. They're probably close. Per the Yellow Book, a firm's peer review reports must This is what Mike calls dancing. I'm not sure I'm that feeling that in this club tonight, right? When I go clubbing, it'll probably look different. Be publicly available. Yes, that is the answer. Accompanying the engagement letter was an old requirement of the HUD audit guide that no longer exists. Lou, 7 or 11. It's really close. 104 points now. And just hit 3 in a row, and it's not on the board yet. Bonuses are going to happen here. Checklist and canned forms. What? This should be easy, right, Benny? I love it. 106 people agree. 10 of us, however, are going to stay after class. Hand in your drink tickets. If you have red on your phone, hand in your drink tickets right now. Because I don't know who's going to talk to you because I'm leaving. Haman or Haman at the Cosmo. I don't know how to say that exactly, but it's still really close. Still 104 points. Haman. Now I know who it is.
No, it's not. I wish.
Oh, okay. Which of the following is not taller than the stratosphere here in Vegas? One of these is not taller than the stratosphere. How would you know that? The Eiffel Tower is not taller. That was easy, I guess. Ole Miss. Okay. It worked. It worked. But we do have a 500-point spread now about, just under. For risk assessment, the auditors should do what? Give me the best answer, the textbook answer for this.
We can't see the answers.
Move your fat butt. Sorry. Oh, that's okay. One day I trained at RSM, and they had a TV showing the camera looking at the crowd in the other class, the other city. I stood in front of that one with my butt 6 inches from it for like 20 minutes before a voice came from somewhere out of the ether. Les, your butt is not that attractive. Just scoot aside. Please move. Document the risks from what can go wrong. Correct answer. Ole Miss is still hanging up there. Beer me, Haman at the Cosmo. It's really close again. Oh, 5 of you dropped. You're 3 in a row. Now the bonus points, you have to start working on accruing more. As it relates to the results of sampling procedures, give me the most correct answer. This is a repeat from single audit. You should report the known question cost as findings. Likely question costs don't get reported as findings. They just affect the opinion decision. Beer me. Okay. We've got a little more spread from the top to the bottom. The first 4 close. In audit literature, assertions. I guess all I can do is stay in the middle, right? Stay out of the front. Stay in the middle. They kind of are the least understood thing next to COSO. But 99% of you had the right answer, but 10 of you have a sense of humor like mine, so I gave you credit. Never a truer thing has ever been spoken. Okay, beer me. Okay, we got a little spread coming up now. Pirate Carnival. Oh, okay, now maybe we need to talk about what we're going to do tonight. If you're going to have a pirate carnival, I might be finding my way to wherever that is tonight. The Eiffel Tower at Paris, Las Vegas is half the size of the original, and the Arc de Triomphe is... Ooh, that should have been a little Mas Grande. Woo-hoo-hoo-hoo! Somebody's excited. You just need to get the trivia? Pirate Carnival! Go Ducks, KPMKE, Haman at the Cosmo. Well, look, this is, now we have a party going on here. Now it's a race. Here we go. In major accounts, inherent risk is low when... Okay, now, gee, folks, we just had a conversation about risk assessment, and you have a Form CX-71. What does internal control have to do with inherent risk? There's a song, absolutely nothing, right? If I say it again, absolutely nothing. If I had that, it would get to play that right now. Just push a button and play that. Now you're going to hear it in your head. War! KPMKE, woohoo! We got a change in leadership here. Now that's a 1,500-point spread. Here we go. Got a lot of questions. CARA. CARA stands for... I do not think you know what it means. Mira mi cara. Look, you got to look for your moments where you can find them. It's really hard in accounting training. 4 of you got it. 66 more got the right answer. Haman at the Cosmo. At Cosmo. Okay. Ole Miss, KPMKE, Beer Me. Go Ducks. Which of the following is true regarding single audit sampling? I have a specific reason for this question to be here. It's on the bottom row. There's a very specific reason for this question to be here. I'll talk about it in just a second. Haman at the Cosmo! Wow. 700 points up. This list is staying close now. People want money. In exercising professional judgment about significant risk, the auditor doesn't have this specific consideration. One of these is not a specific consideration. I like excitement. Yes. Humming at the Cosmo. Uh-oh, we lost somebody out of there. SKW's nudged up into that money slot. Here we go. The top of the Luxor operates a 42.3 billion candela light, the strongest ever. What gas is used? That's why it's really called random trivia. You tell me if you know that. I'm kind of nervous right now, right? Xenon. That was a good guess. Was the best guess there, wasn't it? Okay. Haman. Oh, Haman's a good guesser, too. Well, Kahoot's now winning their own game. They're in the top 5, right? They're up here. Huddy's making a comeback, but it's close. We got one question left. Dual purpose sampling should. Don't look at the slide. There's no slide for you. What should it do specifically? It's my favorite meme. Wasting 3 months of our lives to straighten out 12 months of yours. When I saw that, I gotta go. It's gotta go in the game. Distinguishing between those two areas. That's an important thing. Haman at the Cosmo. Oh, look how close it was. Where's Haman at the Cosmo? Oh, what is Haman at the Cosmo? I need to look it up. Oh, hell, no. What's that? It's a spa treatment. Oh, God. I'm never going to look it up. Okay. SKW. If I finish this day with less than 10,000 steps, it's nobody to blame but you. KPMKE. I should know where that is already, right? Clear across the room. Kahoot or Daisy, you are near me right now? Where's Kahoot? Oh, okay, here we go. So, sir, you must be Daisy. I take it you're Kahoot, right? Yep. Okay. Daisy. Oh, wait. You were Kahoot, so you got something extra here. Daisy, that's your winnings. Don't complain. Excuse me, miss. Okay, KPMKE. Excuse me. Okay, now I got to wrap this up because I got to move on to something a whole lot less pleasant for me, more pleasant for you. Okay, now just the last couple things on risk assessment. Look, this goes a long way into here, but if you weren't thinking about how this is going to really play out, let's just go to something really quick that would help us see it really at another level. Well, I thought I had that okay. Let's just go to debt. I want to talk about one thing particular. Okay, here's debt. What do we know? Straight off the trial balance. What should the change in those two things be equal to? Well, last year's current portion, right? So I said, okay, let's just look at this. There's the change in the mortgage. What was he off by? $7,400, not 85. Why? Because the client had inserted the actual amortization into the mortgage specifically rather than keeping it separate. So it did match. It just was, he had the amortization in there. So I'm risk assessing the mortgage. What else do I know about the mortgage? Well, I got a general ledger with the payments. I have a mortgage statement in my hands. I have an amortization schedule. Think about this. My risk assessment procedures are a comparison of analytical from current year to prior year. I have an amortization schedule. I have a bank or a mortgage statement. I have all this material. What is the likelihood the mortgage hasn't been paid? Now, by the way, if I talk to you about the number one risk from HUD's perspective, and I said, what's the biggest risk to HUD? People will say, mortgage. Isn't that true? It is sort of true because it is a big deal to HUD, but what did HUD do to mitigate their risk? They didn't rely on you. They made the mortgage lenders, or the servicers, report the mortgage balance to them every month. So HUD already knows whether or not you paid the mortgage. RD, they've got the mortgage balances too. Our perspective is what? The risk is low, right? And we had all those procedures to show us, and in fact, it's really low. And as the gentleman said on the other side of the room, you did the confirmation because you set your risk on your escrows a little higher. So look, procedures, remember risk assessment, this planning methodology, we need to get rid of the word planning, kind of in our lexicon. Planning means filling out these forms. Then we go audit. And planning, for as far as we're concerned, is a series of things that happen, but it includes risk assessment procedures. We start auditing immediately. And these procedures then help us decide what the risk is to determine whether the need for further procedures. So we start auditing the minute we start doing these planning documents. Okay? And there's many things we can do to get those risk assessment things. Risk is low. I proved it by how. Reasonable basis to conclude based on what we all just talked about. So it gets really simple. You just have to think. If the form has taken away it's kind of turned our brains to mush. If I got rid of that form and said, here's two accounts sitting by side, here's this year, here's that year, put it in the ledger and said, now, like John, you said it earlier, if I said cash, what's the risk of existence on cash? Well, he would look at that and he would do these calculations mentally, get some stuff and fill it out. But the form's just saying high, moderate, low, and where's the procedures? That's problem number one. Problem number two is we did kind of broke the linkage. We kind of don't pay attention to our procedures versus the risk assessment. So keep that in mind. We should all be fine. There are many ways to do this, and the bigger problem for me actually is internal control, which was an easier thing to solve, okay? Now, I just had one big dilemma to bring up about this, and I'm not sure really how to do this. There are quite a few things that come out of peer review, and the sampling conversation was had here a minute ago. Now, we're going to talk a little bit tomorrow about tenant files. Peter has some stuff in his section, and I'm going to intercede a little bit there and talk about risk assessment of the tenant files themselves. And we are going to talk about one thing here. I thought I had solved my slow problem, but apparently I have not. I want to just talk about a peer review problem. Now, these things are interesting to say the least. I wanted to just address one issue that I have to bring up. Okay, so let's just make that a little bigger. You can't really make a bigger computer than I'm dealing with here. Okay, here's the problem. Now, somebody asked me about this question earlier, and I told them I'd bring it up right now. Here's this challenge. Large nonprofit sponsor. He has 94 nonprofit HUD projects, 20 to 24 unit buildings. What's the challenge? His peer reviewer is going to fail him. Okay? And he's going to fail him because he didn't think that the sampling was appropriate. Now, I don't really blame the peer reviewer. I'm not, beating on the peer reviewer for any particular issue here. He's new to peer reviewing. and is a little concerned. And so the issue was, I think you should have, I think this is it, between populations, he's kind of saying, look, you should have at least 10% of these things selected. And he's told them, I've got a problem with this. So, however, group project samples are not applicable. Oh, this is how the guy responded to him. And he's thinking, I'm failing you. And the guy's quoting all this. So what he said to me, he said, Les, I need to engage you, whatever, to help me. And I said, look, I'm not going to have to really help you. Group sampling. So let's just talk about it from two perspectives. HUD and single audit part. And you're going to have HUD and RD being together in the future. Okay? Now, well, they won't really be together. They'll be together at one level. Everything's tested individually at the project, with the exception of what? Tenant files, security deposits, management functions. So cash receipts, cash disbursements, that kind of stuff is all individual. And we have, this was my email. How exciting to have, this is just before Thanksgiving, you can see. I got this on the plane, and I said, I don't think you're going to have to engage me because I think the AICPA is more useful than me, which is something I'm kind of not always saying. So I said, look, the peer reviewer is correct. Compliance audits in general must test individually for HUD and RD. That statement is not true for single audit. Now, we're going to talk, I'll come back to HUD piece. So ANA guide for government and single audits. If controls over compliance or procedures at various organizations vary significantly, it may be necessary for each location to be considered a separate population, on and on and on. However, it may be feasible for the auditor to obtain sufficient evidence about controls and compliance for major programs by selecting one overall sample. He decided to pick 94 items. What he's really saying is I'm going to pick one item from each project. Now, here's my comment initially. Way too much. I'm not going to lie. It's about 34 too much. The worst case scenario for high risk, I'd be at 60. Okay, now I can make that fly. And he gives you this stuff here. And then it says, I can do this either by, when it's not feasible to visit the place, which is true, we could then visit all or both or across the same organization. The auditor general would select some organizational units from which to obtain audit evidence, and in case he may consider testing the minimum sample size at each location or varying the selection of less significant units. So they're saying I could use group project-based sampling. Or I have another alternative. There are two alternatives. Now here's the thing. We told you just recently that RD won't let you do that, so everybody's testing project by project. In single audit, you can group sample. It might not be the same as HUD. This is actually describing HUDs, okay? Or I could do what HUD wanted and nonprofit, but he didn't have to do that. So we sent that to the peer reviewer, and then he's questioning the sample size. So here you are determining the sample size stuff, and we didn't have to really deal with that. So what did we end up? Then he came back and said, I don't think you now need to put the findings in every one of the 94 projects. Okay? So here were the findings. Now let's just talk about group project-based sampling. Tenant files in particular, we see it a lot. And this is tenant files. So here's the requirement again. Minimum of 4 projects. Owner has to agree. Every project is sampled once every 5 years, and if you have a finding, it should be reported on every project, in theory, okay? I'm not going to make that a hard and fast rule. So look at what he said. I had 1 file with no signed lease, 1 file with no signed application, 1 file had a late recertification, and then 3 files had incorrect asset or income computations. That's a summary of what he found. Now, he's single audit, so I already know he doesn't have to do some of the things the audit guide says. So I said, this is really hard. I said, I know that the lease and housing application were signed, the tenant had been recertified prior to your visit. All that was fixed, right? So there are no question costs related to the first 3 findings, the tenant asset income. this is what he told me, the total recomputation was less than $250 on the 3 files. So here's what we're going to do. I probably am not anxious to report on 6 findings on every project, right? And by the way, none of these things are considered material anyway. He told me I reported them because the client wants me to report them, and now the peer reviewer is going to put him from the gallows, and he's a fail. So this is a good Thanksgiving dinner, right? Turkey did not slow. Look, it's dry enough as it is. If you've got to swallow it with that kind of process, nope. Okay, so let's just think about this. Now, I said this is a difficult thing to project. That's why many auditors don't take advantage of group project-based testing. It's not exactly as hard as it looks because all you have to do is come back and make a couple of changes to this. What you could look at essentially was look, he had 94 files and all 93 of them had a signed lease and only 1 out of the 94 didn't have a signed lease. So why need to put a finding on 94 projects? Going to cost you big time if you try to do that, isn't it, Rodney? Well, he's not going to do it because he knows right away this is bad. I'm not ever going to do that. I said, so let's think about this first of all. On these 3, I just want to go through this because this is important. On these 3, what do I know? He had 1 attribute out of how many attributes in each file did he test? Well, that could be somewhere up to like 15 to 20 attributes on each file out of the 94. And only 1 of those attributes failed. See, this is the dilemma. And I said, I don't think I'm a projectable thing if I look at that. And by the way, the single audit rules or the ANA guide agrees with me. Exceptions observed in the sample are important to determine the compliance testing strategy and should be evaluated to determine whether to report findings of material noncompliance. Further, they may affect the opinion. And I said, okay, calculating the compliance exception rate based on likely. So let's go back to the 3 of them. 3 files had it, and we said it's $250. Now I shortcut this. Okay, this is from the standard 21 or the ANA guide. 17 and 8, 118 and 117, 118. The exception rate is generally accepted as the auditor's best estimate. So I had what? 3 out of 60. In that case, it was 5%. In our case, it was 3 out of 94 had income calculation differences. Now, I don't know the total subsidy. If I had the pure way would be I would calculate the total difference in subsidy by the total subsidy. But I kept it simple and just said, look, 3.2% in known question costs. I projected that out to a total of $7,800. If I had the total costs out of the 250 out of the total population of HAP, it would be less, significantly less. I had a total projectable error of $250 out of the total population of 94 units of HAP or PRAC. This was a shortcut. Got me to $7,800. Likely question costs are less than $7,800 in the 94 projects. Now on the last one are the first 3 for non-monetary. Now I know what the audit guide says, and I'm not against it. There's certain situations where it doesn't play out like they want it to play out. Non-monetary attributes should be document the note exception and consider the guidance contained in uniform guidance to determine if the findings should be included in the schedule of findings and question costs or in the UG compliance audit reporting package. For monetary attributes, which we did, we would document the likely or the known, which we just calculated. When the auditor finds a compliance exception that in itself doesn't meet the criteria of a finding, we could get the assurance that the exception may indeed be omitted from the schedule. Although uniform guidance does not require the auditor to expand his or her sample, there may be additional procedures performed to support the conclusion that the exception is not a finding. Now we had that. Okay, so here's the thing. After we finish all this, he's clear. Okay? Now, group project-based sampling, even among peer reviewers, is a questionable thing. They understand certain things about the rules. But no, who reads this kind of stuff? I mean, never mind. It's me. So when I know that when this comes across my desk, I'm not even worried. I kind of answered him a little flippantly, and then I realized he was probably stressed. And I go, well, let the AICPA help you in the document. So group project-based testing does not always result in a finding at every project. And uniform guidance does not have to do it. Okay? And follow the guidance in how errors get projected. If it has a dollar value, you must project to the likely to determine opinions. Our projection was less than 25, so it was not automatically a finding. Had it been a finding, it could have been reported on every project. I get it. So you have to be very careful. But don't forget that despite whatever the HUD audit guide may say, this other guidance is applicable, okay, on how to project error. HUD was not trying to rewrite rules. They're just saying, we don't care if we just don't require you to expand testing. And, you know, once the peer reviewer got the whole picture, he felt much better. What's he really responding to? The fear that he gets reviewed and this looks like a problem and he's going to get drugged through the ringer without having his ducks in order. Now he feels much more secure because we can quote the stuff, right? I mean, you can quote it. So anyway, be careful on sampling and projections. I just wanted to say that. Document all that stuff. Okay. Now, I have to do something that I'm really nervous about, so we're going to talk. I get a lot of questions initially about, in the last couple of weeks, about opportunity zones. And against all my better judgment, I've cheated on a couple of places and put together some slides from 4 different sources. Let me just say this, the best one that so far, look, is go to Novogradac's website and they have a resource page on opportunity zones. Now, don't expect it, to get a ton of answers because guess what? They don't have those answers either. This is a proposed regulation. This hasn't even been done with final regulations. So this is a 2-prong approach that will lead me into dangerous waters, so please bear with. I'm hoping this to be more of a conversation based on what some of you have heard. We'll get the microphones out here. Mike and Michaela will have to come over here. So I shouldn't probably do this because this is not my expertise. I'm not going to lie. So I said, what will I want to tell you based on what I could find out in 2 days of study? Okay. And leveraging off other people who are smarter than I am on this thing. So here you go, an opportunity zone. That is a census tract that was nominated by each governor and certified by the Treasury, has a QOZ. It's a low-income community, either under Section 45D for new market tax credits, or it could be contiguous with a designated low-income community where income is not greater than 125% of the median family income of the community. Oh. Less than about 25% of the qualifying areas in a state were designated as QOZs. Okay? Now, that's easy to say. There's a list of those at that link. There are about 5,000 to 6,000 HUD projects that are in existence that are in QOZs. I don't know if Kathy put that list on the website, but it will be there. I have one by mortgages and one by HAP. I couldn't combine the two right now, but there are at least 6,000 projects that are living in QOZ tracts, okay? Out of the total of something like 24. Now, the resource place, this is actually here where they give a list of the qualified opportunity zones. You can get it there. Novogradac has it linked. Now, a zone represents a potential investment opportunity for a QOF or a fund. Most of your clients are getting hit right now for investment opportunities in a fund. You want to get in on this ground level, we're going to establish a QOF. They don't know what they're going to invest in yet, but by dang, we're going to take your money and put it in a QOF. So that'll be awesome. So the first conversation you really want to have here is how you might respond to your client about what they should do with a QOF. Now, the second is how it might pertain to housing, and that's a more open-ended question. So it's a vehicle that holds 90% or at least 90% of its assets in a zone asset, a zone located asset or a property. I think you're going to get tired of the acronym QOZ something or QOF something before the 20-something slides are over, okay? Now, it could include stock, partnership interest in a business in which substantial element is tangible property. That's fine. At least 50% of the gross income must be derived from an active business. You couldn't have too much cash, less than 5% of the basis. And it may be purchased with seed money or debt prior to investor contributions. It can be acquired with a mortgage or mezzanine debt. So you see a lot of things happening. Now, the last one is what's important here. For real estate, a QOZ must be new construction or sub-rehab. And that means about 100% of the initial investment must go into the rehab. There's no slide on that. But it tells you within any 30-month period. It's not very specific on when that 30-month period happens. It's kind of like within any 30-month period the fund designates. Okay? Now, what's really important for you to know? The first is all that money in the QOF starts from an investment client or somebody sold that had a capital gain on it. And they don't want to pay the tax on the capital gain, so we're going to defer the gain, the 20% tax, by putting it into the fund. So you're going to defer the capital gain that got the initial capital. Rodney says he'd just soon tell the client to pay the tax, right?
Pay 20% tax and move on.
Instead of 17, never mind, we'll get to there, right? It's all going up. Okay, so the second is anything the fund generates income-wise at a certain point in time will have a 100% basis, and that investment can be liquidated with zero gain. Sounds like a swinging deal, doesn't it? Of course, that leaves you with the idea of what business will I invest in that will go up in value to that level, right? You're jumping on it? He's not jumping. I don't know how affordable housing fits into that model very well, okay? So you're deferring capital gains recognized from virtually any investment. Well, you're coming out of equities, you want to put money in something. Wall Street is selling this. So it isn't even a housing thing. It's kind of like telling your clients, hey, Les, I should put my money, I just sold this, I got to put my money in the QOF. Oh, dude, you may not want to do that, okay? As with most things, when new things come out, there's a lot of initial excitement that maybe should be looked at more prudently. You all know how this rolls, right? Okay, operating income from that business is subject to tax. The gain from the original transaction must be recognized by 2026. And if you dispose of the actual investment after 10 years, at least 10 years, you will pay no tax on that gain. So here you go, right? You invested $2 million in 2015 in that company, sold it for $3 million. You roll $1 million over into the QOF. The $2 million is yours. Do with it as you wish. The $1 million is what you would have paid on the, it's the gain, and we're going to not pay the 20%, the $200,000 tax on that. So you can see it lining out here for periods. Plenty of ways to see this table out here. At least 5 presentations I've seen. Maybe they all leveraged off Novogradac, I think. So a lot of law firms have presentations. So pride of authorship probably goes to 80% of it to Novogradac. So defer the tax, right? 20%. So the first year, for 5 years, you get 10% of that knocked off. So that's $20,000 of taxes forgiven. By the 2 more years, you get an additional 5%. So by 2026, they're going to pay $170 in tax. So they saved 30 grand by waiting 3 years in the fund. Like Rodney said, pay the tax. Okay, now you took the gain. Now you got to pay the gain, initial gain. But what happens with the investment? It starts with 0 outside tax basis. By 2023, you get 20 grand in basis. To 2025, you get another 10. By 2028 to 47, we're going to give you 100% of it. So you liquidate that investment at some point in the future after at least 10 years and take your money and have it all tax-free. Sounds like a winner, okay? So only capital gains. And there's some other rules here about C Corps or partnerships. Look, you're going to get better advice than I can. Look, the rule, by the way, remember, this is all a proposed regulation. There is no final reg on this. So nobody knows how it's going to turn out. And a lot of people are clamoring to get money in there before year end, whether it's housing or not housing. The clients are going to come to you. Someone's going to sell something. I want to roll my stuff into a QOF. Yes, sir.
California, for state tax purposes, doesn't recognize this.
And it might not even roll for states. So
Yeah.
that's what we said. California won't recognize it. There are a couple of other states.
Yeah.
I'm sure. I don't know.
Yeah.
How many more?
I don't know, we're in California.
You're
so-
in California, so you know.
Yeah,
So you're going to pay the state tax anyway, in your case.
Yeah.
Right? Okay. A partnership or a corporation, what that really means from what I can tell is that you're going to be taxed as a partnership. So LLCs, even though it's not quite listed, I think they're okay as long as they're taxed as partnerships. So 90% of that asset, we already talked about that. You can elect to become a QOF if you're already in place. I'm not trying to get too specific here. It's really not. Okay, qualified opportunity zones. I'm not going to open the spreadsheets, but I have identified all of the HUD projects that exist in those zones. Okay, so that is in our possession. I'll make sure Kathy has it to put on the material for that. And so, look, I don't need to get too big into this. Business property. Now, where we're finding most of this, probably commercial real estate. Not affordable real estate, but commercial. There may be places where this works really well. Now, aside from that, you just need to tell your clients to be very careful about how they're being sold. Okay? And this might not even come out to be a great deal in affordable housing just yet. We're not sure. So, I'm not sure where we're going to go. Susan, I think that's what you guys would say. That is really unclear at the moment. But it's clear there's a clamoring to get something going in the funds, right? Ton of pressure. Money is flowing into these funds and nobody knows what they're going to do with it. Okay? Wall Street's gathering the money now and no idea where it goes just yet. So, you can see the listing here. Land, buildings. How does the rule impact bonus depreciation rules enacted as part of the TGA? The bonus depreciation rules allow a taxpayer to fully expense certain assets, but not real estate upon acquisition, resulting in zero basis in those assets. And I think you're finding out that it would mean 1 cent of capital improvements could result in a substantial improvement. And I think that actually comes from you guys, doesn't it? That comment. So what you could say is, look, if you came into that, you could come in with very limited capital, a penny, 1 penny investment, and you could probably end up with something that's worthwhile. But again, specifics matter, okay? very much are a big deal. Okay, so here you go. $2 million in the land, $8 million is attributable to the structure of the rules. The building will satisfy the original use requirement. I'm sure that's true. The amount invested in the rehab building over a 30-month period exceeds the adjusted basis of the building. At the beginning of that, how many 30-month periods can the taxpayer wait? I think that is not yet determined. Okay? During any, so here's the rule, any 30-month period after the date of acquisition. So these are just technical things on how we would get there. And I'm almost done here. Some partnership rules for deferring the gain in investment. Like, I don't need to get into this too much. I have a couple of other things that we probably would like to do before we leave here. Okay, does anyone really have any experience here you'd like to share with somebody else? This was supposed to be a chance to actually get some conversation from the crowd. I'm not an expert. I don't know, the number of people that are really experts, it's probably a very small group of people. Even my friends from Novogradac here, they're just going, we're not experts in this, so. You're going to get questions. I've been out on the road now for the last 4 weeks, and every session somebody asked me about QOZs. Last week it was in Atlanta, or not, into Georgia, and the guy says, I have a client trying to roll in $20 million into a fund today. What am I going to do? What should I tell him? And I'm going, geez, where does this come from? Like, let's decide what to do with $20 million today on a proposed regulation. And he said, the client is pushing me so hard. So I don't really know what to tell him, right? The CPA finally says, you need to take a step back and think about where you're going here, right? Anytime that kind of pressure exists in my world, it's not going to be a good answer. What not deciding to do something is a better decision. So I don't know what to tell you. Plenty of people here know something of it. And as far as housing is concerned, yeah, there are investment vehicles, but where would affordable housing get you that kind of return where you could get that kind of gain later in the process to really make money? Something to defer. I don't know where that is. We haven't quite found it. When they do, I'm sure you're going to hear it from people much more into this than some of us in the room. Okay. I got a couple things I need to do here about nursing homes. Things that don't fit into any other specific list. This is in that section 5 thing in the book. There are some stuff from HUD on this. So for 232s, let me just say this, and now one of the things that is a big deal in the 232 world that may be a harbinger for the future, I can't tell you for sure, is that we've enlisted the lenders as compliance monitoring tools for the 232 projects. Now clearly we were at the operator level and we're doing that. So that's fine. And the handbook provides the indicators that require a borrower to notify HUD. And our answer is when most of these questions come up, the first line of defense is to always call the lender. Forget trying to call HUD. You call the lender. And there's some specific sections in the handbook thing there, and they've got benchmarks, and that's fine. We're not trying to get into this. Now, tomorrow we will talk about this particular thing in general, but this is specific to 232. There's a big push on managing changes in ownership. Peter will cover it tomorrow in general, but if you look at here, participants require prior written approval, and they're saying, look, sell. Well, look, I don't even know where this comes from. You think you could sell the project without HUD approval. Changing operators, changing agents, conveying, put a lien on, modify beds. The first one here is the biggest one for me is liens on the property with promissory notes. Okay? Now, that's going to come out of this, but remodel, add to, subtract, look at that list. Disturbed ground significantly, towers. All these things require HUD approval, and they're just very excited to go out and look at this. Okay. Risk notification requirements, they remind everybody how that's going to work. Now, failure to make a lease payment. This is happening all the time. And we get conversations about, well, the operator didn't make the lease payment. Look, they're telling you right away out of these regulatory agreements, the borrower must immediately notify the lender and the HUD account executive. If the operator can't make their payments and you show up to audit, if they haven't notified HUD, I can't tell you that's an automatic finding, but it's certainly a big consideration. So we see it all the time where I calculate the mandatory lease payment, they didn't make it. In this world now, that's a conversation that requires additional consideration under failure to make the lease payment. And they put these slides out on their website, and you know, the first thing I can tell you is contact, okay? And then they have some notification requirements. A default of a master lease, 2 business day requirements, or a special focus facility. I don't get too into that. Now, surveys. Since physical inspection on a 232 is covered mostly by state surveys, we know this rule. I mean, we've been training it for the last 3 years. Operator must report any notice, report, survey, or other correspondence, regardless of form, from any governmental entity that includes any statement, finding, or assertion that a violation, any permits or approvals could be terminated anyway or not renewed, civil money penalties, operators, sniff surveys higher than G. And you know that. I mean, we've talked about the G surveys before. So they want that. What do we also know? Automatic, we know that we have something to report in Section 2 of the Schedule of Prior Audit Findings. Now, Peter will talk about that tomorrow. We'll stop and have a conversation on that. And then, of course, state inspections is due to the mortgage servicer from the operator within 2 days of the notice. Okay? Now, insurance, I'm not going to spend too much time on the insurance side, or judgments. Notify anything penalties over $50,000. Okay, that's a pretty big limit. And professional liability insurance changes there. Okay, fidelity bond coverage, specific. I'm trying to end here a little early. I want to talk about one specific thing here. So abandonment, I don't think it's a big problem. REAC inspections, there are so few here that do it. Now, accounts receivable loans, 2 business day notification of any sort of default. Now, on this page 20, whatever the slide is, 16 of 29, I think there are 2 to a page anyway, so unauthorized distributions. Now, this is specific. So, borrower must notify the servicer within 2 business days of receiving a REAC notice of unauthorized distribution. So, you get something back from REAC. If the auditor has a finding, it doesn't tell me I have to do that until REAC comes back. But what I would tell the client is you should immediately go notify the borrower. If you know you have a finding, I'm just saying, you get a notification to get a cure period, that's going to happen. But I would go ahead and contact the servicer and say, what do I need to do? Start working on this now. Okay? So that's a specific change that exists only in 232. Okay? Bankruptcy, let's just pray that we don't have too much of that. Now, delinquent mortgage payments. There is a system that tracks this. Peter will go over it tomorrow, but we know you're delinquent if you're past the 16th of the month. So, again, the mortgagee or the servicer has to notify HUD of that. This isn't the client problem. This is a lender problem. Okay? Now, I want to get down to a couple of this notification. I don't know if I actually had what I wanted here to talk about metrics. Some of these other things are interesting. Okay, I wanted to talk about the one I forgot it probably wasn't in this particular thing. What's the single biggest change in 232? Okay, it's not the fact that they've released the rules to get an 80% loan to value cash out. That rule still exists. You cannot go to HUD with a 232, refi, and get cash out. However, what you can do under these new rules now, you can go out if you get HUD approval to get other debt. So here's what somebody else was doing. I'm not sure the scheme worked, so just trust me, I'm just repeating what happened. The CPA called me and said, here's the scenario. They went out to some friends. They borrowed $10 million. They stuck it in the nursing home, in the facility. Then they said, oh, we got an automatic cash distribution thing. We went ahead and repaid their position in the note, but we converted it from equity to debt. So we left the note on the books and distributed cash. Then what they did, they walked right out to HUD and said, we're going to refi. And HUD would then come in and refinance that extra debt without seasoning. And that is in the rule. They will waive seasoning requirements on new debt. So you used to have to wait 2 years or so to refinance that debt back in. Now they're waiving seasoning, so we're starting to see a lot of lenders reach out to clients with, I hate to use the word schemes, but I'm not sure how legit it all is. And they're telling them, if you do this, we can get you to refi and get cash out, right? We'll actually get your 80% loan to value. HUD knows it's possible because they actually changed the seasoning requirements, which would allow many nursing homes to find some scenario. Why did they borrow money from the friends? They avoided fees. So I don't know how good that is going to really work. I haven't heard the end result of it, whether HUD approved it, but that's kind of where they're going. They're finding a way to get cash out without changing the rules. And only modifying the seasoning requirement because they can't modify the restriction on cash out. Okay, I think that's enough for today. I think everybody needs something else to do right now. It includes something with ice in it. Right? We'll see you back here in the morning. Have a good evening.